This is Satya Pradhuman of Cirrus Research. The latest earnings report is just out. This is an outlook for the quarter, and in fact, in this instance, I think it's the outlook for the upcoming quarters. The title, Unusually High Margins, Amplify Impending Earnings Cuts. So we've had a tremendous amount of debate in terms of how much is the tariff noise going to impact really business decisions and ultimately earnings. And I think the consensus is definitely coming to the fact that damage is already done. So the question is, as we go into this earnings season, how can we better isolate and protect from this moment? Foremost, let's start off with potentially the degree of the impact. In this chart, and you've seen it in a number of different flavors, the idea is that there are a number of uncertainty indices that are out there. The one that everyone, I think, has come into is the Policy Uncertainty Index, where these numbers are now really getting back to levels seen as in the early phases of the pandemic. And as much as we all want to play contrarian, so this reading is really high. So therefore, the only thing you can do is go down. Here's the problem. It's the credit markets. The gray bar in this chart represents the credit markets. And in this instance, what it's showing us is that it is starting to back up, but you're coming from 30-year lows in terms of the spread. So it's moved from 300 basis points to Treasury. High yield market has moved to about 300 basis points to Treasury, really climbing up to 400 basis points. So moral of the story is that what worries us is that this uncertainty, this lack of decision making that we are about to go through, will have a real material impact on the credit cycle. It would be very different if the credit spreads had blown out incredibly wide, and then we can look back and say maybe that's as bad as it gets. So let's take this now into this current earnings season, and for that matter, next earnings season. The blue lines in this chart represent the earnings expectations or the upward revisions. And right now, in the large and effectively small cap market, you're looking at a 40% of all estimates are still being raised higher. This has not really changed that much. That said, you could tell from the way the markets have been selling off that the earnings estimates are going to get cut and guidance is going to be guided down. So this is really the target. And in other words, how do we protect for the upcoming cuts? And a few ways to think about this is really this torpedo concept that if earnings expectations are very aggressive, then those are the stocks and firms that are likely to miss. And there's a number of ways to measure it. But in this instance, what we think is that looking to where the earnings estimates are, it may be a little bit better to look a little further up the channel. And in this instance, what we got to was really the margins for corporate firms in America. What we've done here is separated out the margin spreads that we're looking at. So the upper line here are the large cap margins, and you could see the nature of why they're larger firms is that they've enjoyed a significant amount of margin advantage versus the mid and the smaller companies universe. But what's important though is that margins are also leveraged to earnings. So in a good time, this is exactly why the larger firms may end up being benefited. However, if earnings estimates are about to be cut, and in fact, maybe we go on for more than a quarter, then this sort of leverage works against many firms that have benefited from really favorable margins. And when we talk about supply chain, that is all leverage for better margins. If we take a much deeper dive into this, we took a look at the 14 economic sectors for larger cap companies and smaller firms, we are definitely seeing more of a large cap dilemma here. When we look at the sectors, the number of sectors that are north of 2 standard deviations above normal, this goes back with data going back over 20, 30 years, we're looking at, to no surprise, the technology, consumer discretionary sectors. These are areas that have really benefited from a lot of technology, internet sales, etc. In addition to that, business services and materials. In terms of materials, I guess the only reason I think that's here is gold, as that has really rocketed as really globally investors have become nervous. But the bottom line, though, is these are the sectors where we think the impact to earnings cuts are going to be much more significant. We repeated the exercise really for smaller firms as well. While it's benign in the large company industrials reading, in terms of small cap land, the industrials reading is very high. So we've seen the CapEx industrial spend in the last 3-4 years really climb. That has benefited this sector. We are bulls on industrial spending. I think this moment is a cyclical hiccup. We hope that it's shorter than longer. But the reality, though, is tactically, these red dots represents the sectors, and within there, the report dials into the industries that are really the sources of risk in terms of this earnings season. In terms of, if you drill down a little finer and look at this in terms of time series, to say 2 standard deviations above normal, it's a little, it's not as concrete as looking at, let's say, the technology sector and their margins over the last 20 years or so, to see it go from a 20 handle to almost 40% margin premium. So moral of the story is that, the U.S. equities, which is really the large cap market, those margins are also high, but really over time, this has always been the case. There's always been a massive spread between larger company margins and smaller company margins. Here's the fallout and why, if we look forward here, why the risk to large cap multiples may be more severe. Simply put, it's valuations. Now, valuations are never a reason necessarily to buy a group. However, as we get into a place where there's less earnings visibility and there's a slowdown underway, that's really where valuations come into play. Bottom line, we think the fallout that we've seen where smaller caps have been hit harder, I think given this margin and the potential risk to earnings cuts, I think this market is about to broaden in a meaningful way. So likely small caps will hold their own or potentially outperform. Maybe it's going to be in a downward trending market. And importantly, the equal weighted S&P 500 is likely to dominate the market weighted S&P 500. Let's drill into this a little bit more. There are a few themes to really address here. Number one, technology, NVIDIA. Instead of saying semiconductors, it's really NVIDIA. We've been flagging this concern for several quarters now. This is like about 4 quarters of where we've seen top line growth decelerate. What's important is the recent data points on semiconductor buildings. Those have also come in a little softer. We foresee that if you think about cyclicality and a cyclical slowdown, the semiconductor data, it's really the tip of the spear in terms of cyclicality. So we think this is going to move more meaningfully. Now, specifically into AI, let's dig into this a bit. What this chart represents are the margins of the key customers for NVIDIA. So effectively, the Oracles of the world, Apple, etc., they're in here. And what this chart relates is that when the margins are healthy, very healthy, and rising, the budget, the checkbook is open to buy billions in dollars of AI chips. As the margins come under pressure, we think this effectively is a forecast for a slowing in spending on AI. There are a number of other reasons why I think the AI spend will become more diffused, but this is actually a twist to the story because of this sudden shock with the tariff, really the tariff conundrum. Importantly, we've seen banks sell off. We are also noticing that their earnings results are fairly good, especially when you think about trading. However, what's troublesome between the large, mid, and in fact, even the smaller cap banks, the earnings expectations are incredibly bubbly. And this was last year, we were all on board with this, that this was a capital expansionary phase that we were going into, the regulation, the deregulation that we're likely to see, which is still going to be meaningful. The problem is the expectations were built up for everything, including a ton of underwriting. So I think while the underwriting cycle is going to be there for this current period, there is a real pause as multiples compress. That is, the cost of equity is going up sharply for growth stocks. So this is something that we need to be much more careful about in terms of the financial sector. The reality is that if companies are sitting on their hands, the reality is that loan growth is also going to soften here. So this is an area that we'd also be playing defense with, especially if the earnings right now are good because of trading. We think this is a challenge to come. So take a look at the full report. Plenty to cover here. But like I said, this is a longer clip than usual. But please reach out to us with any questions. Thank you.